Great pleasure to bring on board Neelkanth Mishra to talk about the impact of second wave on consumption, macro, why as a house they were the first one to downgrade their overweight rating on metals to underweight, and what is his view on what is next for the global economy. I've always maintained this and I like to maintain it again. He's one market speaker I always look forward to interact with. So Neelkanth, welcome to the show. Hope all is well and things are great and fantastic at your end.
And always a pleasure being here, and thank you for inviting me. Hope all well with you as well.
Yes, thank you very much. I'm going to start with a very basic question. And the very basic question that is that markets, based on the experience of first wave, are assuming that the impact of the second wave on the economy is going to be limited, and they're playing with that playbook which is called the recovery trade. Do you think markets are getting slightly complacent, or you think that the same economic factors will be at play and we could be in for that same pattern once again when the recovery starts?
No, I do think that I think the economy will be fine. We will have our issues, but I think the growth will surprise. In fact, what we are now saying is that for FY22 itself, the consensus real GDP growth forecast of about 9.5% is perhaps 200 basis points lower than it needs to be. And increasingly, it's looking likely that FY23 numbers, I know it looks very far away, but it's, in 6 months' time, we'll be thinking about FY23. FY23 growth numbers need to be bumped up meaningfully. And let me explain why I feel so strongly about this. There are two ways of forecasting, right? So the one way of forecasting is you take year-on-year growth and you say that this was my base. On this, I grow 9%. On that, I grow 6.5%, 7%, which is what I think most people do. In times like these, when there is significant volatility, like, at the bottom of the pandemic, the second wave, the GDP in our estimate was at one point running 21% below FY20 levels, and now it is rebounding very fast. It is perhaps better as a forecasting method to look at the pre-pandemic path, right? So there was a 6.5% CAGR pre-pandemic path, which we were on even before the pandemic hit, and where we are below that. Now, what people generally do is they use the year-on-year growth number and then measure where we are versus the pre-pandemic path. I think a better methodology, given all the volatility in year-on-year numbers, is to start with that assumption and then see what growth you are getting. So on that measure, before the pandemic, if you apply a 6.5% kind of growth CAGR for 3 years, FY23 should have been 121, 120.56 or something, if FY20 was 100, right? Current forecasts by consensus of FY23 GDP are at about 107, 108 right now. I see no reason why that should not be at 114, 115. So we are still below the pre-pandemic path, and that's something that we need to worry about. But I think the recovery in terms of estimates and growth is actually likely to be far better than what is currently being expected. Generally, Indian economy and Indian markets are not that tightly linked, but in times like these, suppose you are a sector analyst or a stock analyst and you need to forecast FY23. What are you going to rely on? You're going to rely on the fact that, okay, my house economist or consensus economic growth is X, and therefore let me anchor to that. And therefore, this is not the case in normal years. In normal years, the differences in growth are in tens of basis points. Okay, they're at 6.5, I'm at 6.3 or something like that, right? In these cases where FY23 GDP could be actually 5-6% higher than what is currently being forecast in terms of levels, the likelihood of earnings estimates also needing to get revised up is very high. And what that suggests is that, FY23 EPS, Nifty EPS, has already gone up from about 750, 760 to about, for the first time it was introduced in September last year, to 860. This is, and you've been following the market as long as I have, this is very, very rare. That generally you were used to starting here and ending 30% lower. This time we've seen a 10-12% increase. And I think that there needs to be more of an increase there. Therefore, as a policy, if I was a policymaker, I would worry about the fact that we are below the pre-pandemic path, because that's spare capacity in the economy. There's a problem with jobs. But at the same time, in the markets, I need to be cognizant of the fact that the numbers need to be upgraded. And therefore, I think the markets are going to be fine.
Great answer. Your call on suddenly turning underweight on metals from overweight, a sector which you track with double magnifying glasses, certainly surprised me when that report hit my mailbox. And the logic here is valuations and China. Can I come back by saying that let's ignore China but focus on US and India, and then all the worries will be taken care of?
Yeah, so I think that there is, of course, you can't talk about metals without talking about China. So we need to be cognizant that they are now 55-60% of demand in most of the metals. So you need to be, very, very aware of what's happening in China. But there is something much bigger happening. So as the economy is opening up, and I keep talking about this supply chain bullwhip, that last year, even though car sales didn't really fall to zero globally, there were periods where the car makers were not manufacturing. And therefore, if you move from that end demand, and this is just an example, the same can be applied for many other supply chains. If your car manufacturing production slows down, your component demand slows down, the subcomponent demand slows down, and then eventually steel demand slows down. And just like what we saw in 2008, late 2008, early 2009, there was a period where there was no steel orders and steel capacities were shut. And this was the downward leg of the supply chain bullwhip, that if everyone destocks in the value chain, if end demand moves only slightly downward, there can be a possibility that there is no steel order at all. This falls to zero. The reverse of that is also equally likely. And that was the reason we were overweight metals. We actually added to our overweight as we saw the global economy and the global supply chains revamping. In December, we added to our tactical overweight on metals. Now, I think we are going to see a leg down. So you're starting to see that. You're starting to see that in lumber, which has got a lot of publicity. That in the US, lumber prices have just shot up and now they're correcting equally sharply. You are seeing that as we were discussing, or you were discussing just before I came on palm oil. We are I think, very likely to see that in steel as well. And that's the argument. So it is less about structural demand issues, which we can discuss, but they generally move around only 2-3%. It is more about the inventory cycle, and not the inventory cycle that you see at distributors, but inventory cycle as seen, as what they're finding in lumber, for example, is that, small distributors, even someone doing repair work in their home, were all storing up on lumber. And I think when prices go up, like in the US, they went up from $500 to $1,500, then it is very likely that people would be front loading their demand and all that. So I think it's a call on that. And that also predicates our upgrade of materials like cement, which where some of these elements are cost, in the sense that like cement, you can't build inventory, right? So you are kind of safe on the demand side, that there's not too much of excess inventory being built there. On the cost side, so if say something like pet coke, you are getting hit by the same supply chain bullwhip, which hurts plastics. The same steel thing is happening in plastics, it's happening in other petrochemicals. Now you're starting to see the petrochemical margins are starting to come off. And I know at this stage, it looks like a leap of faith that, I think they will keep falling, and let me find stocks where these become cost elements. And therefore, these stocks can see margin tailwind 6 months down the line. In the markets, you need to be for at least 4 to 6 months, not at least, ideally 4 to 6 months ahead. If you're 2 years ahead, then you lose money. So the thing is, I expect that this bullwhip to start correcting downward. And that was the reason we changed. So we switched from steel to aluminum. So we went from overweight to underweight on the metals, and we added to cement and some other discretionary stocks which can benefit from this cost reduction.
Okay. So if you have to put things in perspective for our viewers and for those who follow you, which is that I'll break the question into two parts. You already alluded to the fact that we are in an earnings upgrade cycle. But if you have to, let's say, connect that with the market cycle, because markets, we both know that they are forward looking. What kind of market and earnings cycle combination are we in?
Yeah, so the first thing that we need to keep in mind when we are thinking about markets, I'm glad you asked this question, is that the markets are extraordinarily expensive. There's something that we have been flagging for the last 8-9 months now, that on PE multiple basis, the markets are at extraordinary levels, many standard deviations above normal. At a global level, of course, on a relative basis, we are not that badly off. But on an absolute basis, so the markets are expecting or anticipating, or let's say pricing in a very strong earnings recovery, right? And that's why in the 2021 outlook that we published in December, we had said that, look, for the markets to do well, we need FY23 EPS to start moving up, right? People thought, we have no idea about the next 6 months, we're talking about FY23 EPS. I mean, how does it make sense? But that's what the market's going to be trading on, right? And so what we have seen is that FY23 Nifty EPS has gone up by about 11-12%. Now, the important thing is how much further can it go? Because if FY22 EPS is up 35% over FY21 and FY23 is 20% above FY22, does that mean that we see 1.35 into 1.2? So basically 60% kind of growth? In the market, I don't think so, right? Because the PE multiples are anticipating some of that. But if FY23 EPS was to rise another 10% from here, even say 5-7% from here, in fact, I'm a conservative person, so let's say if they don't get cut from here, can the market move up another 10% in the next 12 months? I think so. So if you're looking at Nifty, I think that kind of a return is possible. But to expect that because earnings growth is that high, and therefore, because the market is pricing this in, I don't think this is, while individually some people may be surprised, I think the collective wisdom is that earnings recovery is likely to happen. So some of that is priced in, I think.
Okay. So, the major beneficiaries there, Neelkanth, and you're already taking note or starting to include those to the portfolio, counting on the normalization of the portfolio in terms of, let's say, cement or pockets with pricing power, industrials, certain areas that are likely to benefit from the trend that you've described. If you could just talk us through that in terms of, how prudent it would be to look into including some of these pockets and the kind of opportunity that you see for some of them as we start to see the trend that you've described play out.
Yeah, thanks. So the first question is, if this is our pre-pandemic path, right? So this was the let's say the potential growth that people expected, and then what we should all have expected. And if we are not 10% below that, so if instead of 121, we are not at 107, 108, but say 115, 116, then the risk of industrial capex or private sector capex or for anyone to add to capacity being like 3 years away is no longer there, right? So if you are 10-11% below, you're almost 1 year behind where you needed to be, and therefore the need to invest in new capacities is then pushed out. On the other hand, if you're only 3-5 years away, I think the likelihood of getting surprised that some sectors start to do capex much faster than expected is there. The second is that we assume that government somehow continue to work uninterrupted even in the middle of a pandemic. See, unlike for some of us, I mean, I've been sitting in this room the last 16 months, it is very hard to work in the government from home. And the governments are generally geared for disaster management or disaster management, which is acute, right? So if there's an earthquake, how do you respond? And I think there are strong protocols to manage that. A 15-month period where half the people can't come to office is a very, very hard thing to manage in the government. And therefore, I think government spending has slowed. I think at the central government level, many of the projects I think are moving along very well. the road projects, and they're I think better geared up. At the state level, I think the ability to issue the checks and get the projects going, I think has taken a backseat. So as vaccinations pick up, as we become more comfortable with the opening up process, I think state government spending on infrastructure and some heavy industrial stuff is actually going to pick up. So that's where I see the biggest upward surprise. Now, if when that happens, obviously loan growth is going to pick up, right? So personal loan growth has been pushing up lending for the banks for a while, but it may not be prudent to start growing it at 25%. But there are other drivers. I mean, there are things like account aggregator model which could start rising. So I think that the earlier than expected revival in private sector capex and the corollary of that being that loan growth will be better is the reason. These are the reasons why our strongest overweights are in banks and in industrials.
Okay. Neelkanth, do you see any near-term risks to the current picture? Because markets have been factoring in the recovery for a while. They've been ahead of the game. Global cues have been more than supportive. So apart from inflation, talk about tapering, and the larger, global cue in that sense with regards to continued stimulus, back home, the story has persistently been that we're going to get on track again. Keeping, of course, unknown medical news aside, do you see any major near-term risks to factoring in such a confident recovery?
Yeah, so let me clarify what I said just before this, that the market has been talking about a recovery. All I'm saying is that the recovery is going to be better than is currently reflected in estimates, right? So everyone thinks that we will grow, right? So we were at 93. If FY20 was 100, FY21 was at 93. And that 93 in FY23 can go up to 108. So people are expecting a recovery. What I'm saying is that it can be better than expected. But I think risks are very important. We need to be very, very cognizant of that. And I think there are several risks at any point of time. I think there are risks in the market. The first is global financial volatility. As of now, I think the bond markets have been relatively calm despite the inflation prints that we are seeing. Our view is, because you may have seen, assumed or understood from our downgrade of metals and my expectation that the cost will improve for that, we think that this is going to be temporary. But if the policies in the US can keep pushing up wages, and the fact that right now, there's a big mismatch. You must have read that, especially in some states where the openings are far more than the unemployed people. Even that scenario, if wage pressures start coming up and then bond yields suddenly start shooting up again, I think there can be significant market volatility. And the April underperformance that India had has been more than made up in May. So we have, I think, more than caught up for that. So therefore, now going forward, a lot of what happens to our forward price to earnings will depend on what happens to the global markets. Similarly, I think the growth patterns in China, a lot of people believe, and including our house, that China is in what we call late cycle growth. So now we are starting to see goods demand, not just in China, but say, even in the US, like, TV sales were down sharply. You must have seen retail sales yesterday disappointed. So as the focus shifts, as the spending shifts from goods back to services, hotel rates in the US are like at skyrocketing levels. There's a strong recovery in airline traffic. So as that starts to happen, what happens to goods demand? And as the world adjusts to that, the markets adjust to that, I think there will be quite a bit of volatility, because these are not signals which are easier to understand. And always remember that there has been significant increase in wealth and income inequality, and it will be politically tempting for many governments, actually most democratically elected governments, will try to respond to that, and if they don't, some of them will get voted out. So as those policy errors, those policy decisions can sometimes be erroneous, and so the risk of this wind down being very, very destabilizing is very much there. So even if we can see what, we can hope that 12 months later the markets could be X% higher, I don't think it'll be a straight line. So I think there are several risks, and of course we have. Let's not forget that it's almost inevitable that there will be a third wave. Our hope is that with very high levels of seroprevalence, the virus may have inoculated more people than the vaccination, and the vaccination itself is picking up. So our hope is that by the time the third wave hits, there will be enough people with antibodies that will be a much milder one. But what if it hits us much sooner than that? One last uncertainty, for which we have no data, so we are kind of flying blind with that, is how much damage has the informal sector gone through, right? Because there is risk capital in the informal sector, which people have literally consumed, and will that? I mean, how much of a drag will that be on the economy? We think there will be a drag because that's why we are saying we'll be below the pre-pandemic part. We don't know how big that is going to be till we get some data. So I think those are the risks and uncertainties that I see for the market as well.
Neelkanth, we always speak about macro valuations, a bit of global, connect, but let's talk about the market behavior and the participation. There was a time when we would say that there are two signs of a bubble or a market peak: activity in the IPO market and the retail participation. The retail participation globally is at a record high, and the IPO activity is about to start with mega issues like Paytm and others. So the classic old timer would say, "Bhai bach ke raho." Both the signals are now flashing red.
Yeah, and I think some of the moves that we have seen in the much less liquid small and mid caps do suggest that things are starting to become quite a bit frothy. So I would sort of be careful about what we end up buying. As I said, at the headline level, we are mostly caught up with what happened. The decline in April, and there is at a headline index level, you can't really talk about a 20-30% upside anymore. It will be more steady state, and within the market, I think there will be changes. The frothy stuff that we are seeing, of course, there is even in the US, in some of the penny stocks, or what used to be penny stocks, and they are no longer. We are starting to see quite a bit of froth. In some cases, the froth is coming off, but and so therefore we need to be very careful. If we are investors and not speculators, then we need to be very careful. But having said that, I don't see a catalyst for that yet, because whenever the catalyst comes, some of these stocks can be down 20-30%. So I would myself not dabble in them, but. I don't see catalysts on the horizon in the next 3 to 6 months that reverses some of the trends that have driven this kind of speculative behavior in the markets. Generally, when economic momentum is strong or is picking up and is surprising on the upside, it is almost like a side effect of a medicine that these things do happen. In the early 19th century, when the Americas, and at that time Latin America, North America were kind of peers, there was this boom in lending. So the equity markets weren't that developed then, so it was more of bonds. And there was this adventurer who raised money for a country which didn't exist. So this is to be one has to be very careful on what we are buying. But as a neutral observer, whenever there is an upward momentum, upgrades possible to future growth, this frothiness in specific stocks and outright speculation is a side effect.
Going higher, and with each passing day, two things are happening, which is number of stocks hitting a 52-week high, that is increasing, and number of disbelievers also, that number is also increasing. So you got two highs which I meet every day: price high and disbelief high.
Yeah, so I think as I said, I think in the small and mid caps, my understanding, because of most of our focus is on the large caps, I don't really understand them that well. and they can be driven by very idiosyncratic things. Like, it is possible that maybe some small sectors could be seeing exceptional ordering. So right now, used car sales in the US have gone up a lot because new cars are not enough new cars are being produced. And whenever the supply chains normalize, it is possible that some small auto component company could be seeing very strong order flows, and there's a great opportunity for some of them. So it tends to become very idiosyncratic when you are in the small and mid cap space. So very hard for me to comment on who will be right. But yes, but I would be careful when we are investing in some of those names.
Okay, sure. Point taken. Neelkanth, great to have you on the show as always. Thanks for joining in.